Silver just blasted past 49.50 per ounce, hitting a multi-decade high, the strongest move in years. What's driving this surge? Stay tuned, I'll break it all down. Post by the great Martis. Silver is testing resistance. It may consolidate or overshoot to the 60s before any real reasonable consolidation. RSI still has room to move upwards. The next couple weeks shall be telling. Martis is pointing out a key technical moment. Silver is at a critical resistance zone. The price is pressing up against levels not seen in years. The RSI, or Relative Strength Index, still shows room for momentum, meaning the move hasn't gone overheated yet. If it breaks through this level and touches the 60s, that would confirm a strong bullish breakout pattern before any correction phase. Post by Northstar. Silver. Behold the 46-year cup and handle with a 10-year forecast. One way or another, we go much, much higher. This is a powerful statement. A 46-year cup and handle pattern is one of the longest bullish technical formations in any commodity. Historically, this pattern signals explosive upside when it completes. Northstar is essentially saying silver could be entering the breakout phase of a multi-decade cycle, something that only happens once in a generation. Post by Peter Brandt. Just to point out, in case some of you amateurs do not know, there is no such thing as a triple top. Do with this knowledge whatever suits your fancy. Peter Brandt, one of the most respected chart analysts in the world, is reminding traders that what many think is a triple top, a bearish signal, often turns into a continuation pattern in strong markets. In simple terms, he's suggesting that the recent silver price pauses might not be the end of the move. They could be pauses before another leg up. Post by Gold Silver HQ. Don't get obsessed with the magical $50 nominal all-time high. Silver's real ATH is much higher. This is an important insight. The nominal high of silver is around $50, but adjusted for inflation, the real all-time high is closer to $150, $180 per ounce. That means silver is still undervalued in real terms, giving plenty of upside potential even if it simply returns to its inflation-adjusted peak. Post by Ted. Gold is up 54% this year. Silver is up 69.7%. Such rallies often happen when something big is about to break. Ted highlights a crucial historical signal. When both gold and silver rise sharply together, it often precedes major shifts in the global economy, from inflation waves to currency revaluations. This kind of synchronized rally suggests institutional money is moving into hard assets as a hedge against financial instability. Post by Echo. Silver, God's money is waking up. For 2,000 plus years, silver has been the people's money, but somewhere along the way, they suppressed it. They buried it under 360 paper contracts for every real ounce. Yet the charts don't lie. Silver is breaking out of a 45-year cup and handle formation that started in 1980. Echo's message is both historical and symbolic. Silver has always been tied to real value, tangible, physical wealth, not paper promises. When he mentions 360 paper contracts per ounce, he's referring to how the futures market trades massive paper quantities of silver without real metal backing. This imbalance often sets up violent price corrections when physical demand surges. The fact that silver is breaking out of a 45-year formation adds more technical evidence, the kind of setup that has historically led to major revaluations in precious metals. Deep dive conclusion. All 6 posts, from Martis, Northstar, Brandt, Gold Silver HQ, Ted, and Echo, point to one unified theme. Silver's long-term suppression phase might be ending. Technically, the charts support it. Fundamentally, industrial and monetary demand are rising. Psychologically, investors are waking up to what real money means in a world of excessive debt and fiat devaluation. If silver truly breaks through major resistance in the coming weeks, we might be witnessing the start of a decade-long bull run, something many analysts have been waiting decades to see.
FX Empire recently published a detailed forecast titled Gold and Silver Price Forecast, Market Eyes $4,100 Gold and $50 Silver by analyst Arsan Ali. The article points out that investors are turning back to precious metals as the Federal Reserve prepares for more rate cuts and as global economic uncertainty grows. But there's more to this story than a headline. Let's unpack the deeper trends. Fundamentals driving gold and silver. Gold and silver are reacting to one core driver: monetary policy. Markets now expect 2 rate cuts by the Fed before year-end, one in October and another in December. When rates fall, the opportunity cost of holding metals drops too, making gold and silver more attractive as stores of value. On top of that, central banks are buying massive amounts of gold, 15 tons just in August, while investors hedge against a weakening dollar and rising debt. This combination of monetary easing and safe haven demand is what gives the $4,100 and $50 targets real credibility. But silver has a split personality. It's both an industrial metal and a monetary asset. Half of global silver demand now comes from renewable energy, solar panels, and electronics. So while gold reflects fear, silver reflects both fear and innovation. That's what makes it so explosive. When both industrial and monetary demand rise at the same time, silver outperforms gold by a wide margin. Technical breakdown. FX Empire shows gold trending in an ascending channel, recently breaking above $3,992, with support near $3,940 and resistance around $4,096. Silver sits near $48.78, following its own bullish channel. The next breakout zone is $49.50 to $50.16, a level not touched in over a decade. If silver closes above $50 with strong volume, it could ignite a run toward $55 or even $60. But if it fails, a pullback to $47 is likely before another push. Here's where the article gets it right, but not deep enough. Silver's true supply chain is tight. Mining output is falling, while industrial demand is growing. And behind the scenes, hundreds of paper contracts are traded for every ounce of real metal. That means if large investors start demanding physical silver, not paper, we could see a real squeeze, something that pushes prices far beyond the models. Risks and divergence. But it's not all guaranteed. Silver can lag if industrial demand weakens or global growth slows. Gold might hold steady while silver cools off. And if the Fed delays its rate cuts, both metals could pause temporarily. That's why smart investors track not only the charts, but also central bank policy, manufacturing data, and inflation trends. In short, the $4,100 gold and $50 silver targets aren't fantasy. They're technically and fundamentally supported. But volatility will be high. If silver breaks above $50, the next leg of the bull market could begin. If not, it's a setup for accumulation, not panic. Stay sharp, stay informed, and keep your eyes on the real assets. Disclaimer: the information provided in this video is for educational and informational purposes only. It should not be considered financial or investment advice. I am not a licensed financial advisor. All opinions expressed are based on publicly available data, market research, and personal analysis. Viewers should always do their own research and consult with a qualified financial advisor before making any investment decisions. The markets for gold, silver, and other commodities are volatile, and prices can fluctuate rapidly. Past performance is not indicative of future results. This video may reference public posts or articles from other creators or news outlets, which are used under fair use for commentary, analysis, and education. All rights remain with their respective owners.